Good morning and welcome again. Nice to meet you all again. And I'm very happy to be here to give this presentation. I'm going to take my mask off to speak, if that's okay. I'm going to talk about a general presentation on the role of state treasuries in managing fiscal risks. This is a very large field with a lot of things to cover, so I'll sketch over the ground pretty quickly and I'd welcome questions at the end. Or do I do this quick clicker? Hold on. Here we go. So what I'm going to discuss is several areas, several sections. Firstly, what are fiscal risks and why are they important? Secondly, what is the role of the Treasury in managing fiscal risks? Thirdly, how should fiscal risks be measured and monitored? Fourthly, what tools are available to quantify and manage fiscal risks? And finally, some conclusions and a few questions for you as participants to stimulate some discussion at the end. So first of all, what are fiscal risks and why are they important? So fiscal risks are related to levels of public debt. When levels of public debt are high, fiscal risks tend to be high as well. And this chart shows how over the period since 1880, public debt levels have fluctuated wildly, but the level of public debt is now at the highest level since World War II. So it's now exceeding the very high levels achieved at the end of the Second World War, both for advanced economies, shown in blue here, and for emerging markets. So we have very high levels of public debt. They increased during the global financial crisis, and they've gone even higher with the pandemic, with the COVID pandemic. So we have public debt, very high levels, and that implies that fiscal risks will also be very high. So what are the main sources of fiscal risks, and what are fiscal risks? Fiscal risks are factors that may cause fiscal outcomes. I mean by fiscal outcomes levels of public expenditure, levels of revenue collection, and levels of the deficit and public debt. So fiscal risks are the factors that cause fiscal outcomes to differ from forecasts and expectations. And they're usually divided into three different classes. First of all, macroeconomic risks, risks related to unexpected changes in GDP levels, levels of inflation, levels of commodity prices, and so forth. Specific fiscal risks, and which I'll come to in a moment, and fiscal risks related to institutional factors, governance factors, levels of corruption and fraud in economies. So those governance factors are called institutional risks. And focusing on specific fiscal risks, we can divide those into two areas. First of all, contingent liabilities, which are the occurrence of discrete and uncertain events, and other specific risks, factors related to specific sources or events not otherwise included in the budget. And contingent liabilities can also be divided into two kinds. Firstly, there are explicit contingent liabilities, which are based on firm government obligations or declared policies. For example, government guarantees, deposit insurance arrangements, public-private partnership contracts, legal contracts of various kinds that the government enters into, and also implicit contingent liabilities, which are those based on expectations among the public that the government will provide support in case of need. For example, for bailouts of financial institutions, for rescues of failing public corporations, natural disasters, and so on. These are implicit because they're not contained in any contract or legal document issued by the government. So those are the main sources of fiscal risk. And during the COVID pandemic, As you'll be well aware, there have been various kinds of fiscal risk exposed. A lot of macroeconomic risk because growth rates have been severely affected by the crisis. Inflation is now going up in many countries. And there's also been a lot of fiscal risks related to public corporations or state-owned enterprises, government guarantees being called, also fiscal risk related to failures of local government. So those are the sum of the fiscal risks that have come to pass during the COVID pandemic. This is a chart taken from some work done by the IMF a few years ago. And this shows that fiscal risks tend to be large, they're correlated with each other, and they occur surprisingly often. So in this chart, the blue bars show risks related to the financial sector, to financial institutions. It also shows the red bars show legal risks, risk of natural disasters in yellow, risks related to state-owned enterprises in green, and so on. And you can see on the left, on the vertical axis on the left, the number of episodes of fiscal risk that have occurred at different points in time, and on the right-hand side, the vertical column shows the total fiscal cost, which in some years has risen to over 4% of GDP during the global financial crisis, for example. So these risks are large, they're highly correlated, so when you get one kind of risk occurring, others also occur, and they're also very erratic from year to year, but in peak years they can be very substantial indeed. And this is another chart which shows how fiscal risks are large. On the vertical axis we're showing the probability of occurrence, and on the horizontal axis we show the average fiscal cost. These are data from 2016, so they could be updated from now. We probably find, for example, that the risk of natural disasters has increased compared to 2016. But you can see some of the important ones, such as macroeconomic risks, risks the financial sector, and risks from natural disasters and state-owned enterprises, and from legal claims. And you can see how the cost varies, and also the probability varies from different categories of risk, between different categories of risk. So these are very important and very large. Now, what is the role of the state treasury in managing fiscal risks? And I wanted to put a couple of tables here just to illustrate what I'm trying to say. First of all, I think it's useful to think about what are the functions that state treasuries carry out. And down the left side of this table, I've classified the various important public financial management functions, such as macro fiscal analysis, the preparation of the budget, public investment planning, debt management, tax policy, revenue and customs administration, monitoring of budget execution, fiscal reporting, cash management, and so on. So those are the PFM functions, the core PFM functions you'll find in any country. And then where are these allocated? They may be allocated to the Treasury, or they may be allocated to other Ministry of Finance directorates, such as the Budget Directorate or the Fiscal Policy Directorate, or they may be classified to other agencies, such as the Debt Management Office. In some countries have debt management offices, or the Procurement Office, for example, or some of them may be allocated to line ministries. No country has the same system. They all vary, but I've marked in blue, in dark blue, the functions that I think are particularly relevant to the Treasury, and you'll see those cover things like the monitoring of budget execution, consolidated fiscal reporting, cash forecasting, and cash management. These are some of the functions which are core to the Treasury departments in most countries, and risk management and guarantees as well. And here are some of the other functions carried out by government in the finance area: oversight of financial management systems, accounting systems and policies, the processing of payments and internal controls, internal audit, public procurement, oversight of state enterprises, and so forth. And again, I've indicated here the functions which are mainly carried out by the Treasury, And those include accounting standards and policies, internal controls, the processing of payments, and so forth. Again, no single country does this in quite the same way. There are variations from country to country in what functions are allocated to the Treasury, but these are some of the main areas where the Treasury is responsible. So it's important to relate fiscal risks that the Treasury is responsible for to the functions they actually carry out in government. So I think the Treasury has a special responsibility for managing contingent liabilities. For example, Treasuries prepare financial statements, often in line with international standards, the IPSAS standards I'm sure you're familiar with, and these must disclose contingent liabilities. For example, the liabilities arising from court cases the government is likely to lose. And that disclosure is specified in a particular IPSAS standard, IPSAS 19 in this particular case. Another example of these disclosures in financial statements is on guarantees and other financial commitments, and these are very important in relation to the management of fiscal risks, and you'll find these disclosure requirements in IPSAS 41, the International Standard on Financial Instruments, which requires that financial guarantees are recognized at their fair value. And Treasuries also may be responsible for managing fiscal risks related to public debt and public assets and liabilities, depending on the organizational structure of the government. In some countries, Treasuries do have these responsibilities. In others, some of them may be carried out by a public debt management office. So these are some of the areas where I think Treasuries have particular responsibilities. You may have other views about other responsibilities that are important to Treasuries. Now, a third area I wanted to look at is how should fiscal risks be measured and managed? And this is just an illustrative table, an illustrative chart, which shows how you might think about classifying different kinds of fiscal risk. So I'm trying to measure on this one two particular dimensions or components of risk. The first component is the likelihood that a risk actually arises any year. This could be low, maybe less than 10%, it could be medium, 10 to 50%, or it could be very high, greater than 50%. So the likelihood of realization of the fiscal risk is one dimension that Treasury should think about. And the other dimension is on the vertical axis, which is the fiscal impact. Is that likely to be low? Is it likely to be medium? Or is it likely to be high in relation to GDP? And then you can begin to classify different kinds of risk against these two dimensions. For example, natural disasters, or the COVID-19 shock, or calls on government guarantees, or tax refunds under litigation, or a slowdown in economic growth, or increased inflation. You can place these items according to whether they have a high or low fiscal impact, or whether the likelihood of realization is high or low. This is a useful conceptual framework for thinking about risks. Now here's an actual example of how this is done. This is from what's called a fiscal risk register in the country of Ethiopia. I've summarized the information here greatly. The actual tables are voluminous, and there are many, many other aspects of it, but I've tried to simplify it here just to illustrate how they do this. On the left-hand column, you have different categories of fiscal risk. So you've got macroeconomic shocks, central government debt, loan guarantees, risks from public corporations, risks from public-private partnerships, risks from legal claims. The second column shows what specific risk is being talked about here. So it could be on the macro side, a shock to GDP growth. It could be foreign exchange rate volatility. It could be the failure of borrowers to repay guarantees, to repay debt, and therefore the call-up of guarantees. It could be the failure of public corporations to meet their performance benchmarks. It could be issues related to public-private partnerships, such as exchange rate volatility or cost overruns, or it could be legal claims, such as bilateral investment agreements with other countries, contracts with companies regarding tax refunds, and so forth. So that's one dimension. The other thing to work out is who's responsible within the government for managing these risks. In some cases, this could be the Treasury, for example, in relation to loan guarantees or legal claims, but it also might be other departments and directorates of the Ministry of Finance, the Budget Directorate, Fiscal Policy. It could be a debt management department, if a country has that. It could be a public-private partnership directorate, if the country has that. It could be the Ministry of Justice, if the country works that way. So you have to identify who is the risk owner of the risk, who's responsible within the government for that particular risk. And in some cases that would be the Treasury, in some cases it would not. And then what are the sources of information that you need to measure and monitor these risks? These would include the IMFs system, that include macroeconomic projections, might include the central bank on debt issues, it might include a debt recording system on loan guarantees, might include a public corporation unit at what's called in Ethiopia the Government Portfolio Management Unit. It could include PPP contract documents, could include the Ministry of Justice. So you should identify the sources of information for these various risks. And then you've got the classification, which I discussed before. What is the likelihood of these risks occurring? Is it low, medium, or high? And what is the potential fiscal impact of these risks? Again, is it low, medium, or high? So this is the way you can classify this into a formal structure. I think this is quite a nice example from the country of Ethiopia. I don't know whether any of the countries in this room today have a similar approach to monitoring and recording risks, but I'd be interested to hear. And then we have fiscal risk statement. This is a statement actually from home. This is from the Philippines. It's their 2021 statement. Many countries are now preparing fiscal risk statements, and these are often published with the budget documents, and they provide comprehensive data and analysis of fiscal risks and how the government is responding to those fiscal risks, what kind of mitigation strategies. So these fiscal risk statements are providing comprehensive data and analysis of risks and the government policy response. So this example from the Philippines, which the 2021 statement has a lot of information in it about transparency, the information governments are publishing, the impact of COVID-19, the disclosure of contingent liabilities, and the government's fiscal risk strategy. And some highlights of the 2021 fiscal risk statement included that the banking system remained robust, that there were substantial contingent liabilities which presented risks, that local governments were experiencing a period of high fiscal stress. That's a fiscal risk in its own right. And that the exposure to natural disasters was a critical issue for the country. So this is a very useful way of encapsulating in one document a lot of information and analysis about fiscal risk. Many countries are now moving down this path with assistance from the World Bank and the IMF to develop these comprehensive statements. And then countries should think also about how to mitigate risks, and those cover and come in several areas. There are things that governments can do to avoid risks, for example, by reducing ownership of public corporations, or developing private insurance and financial markets, introducing, where possible, no bailout clauses into their legislation. They can try and cap fiscal risk by putting ceilings on contingent liabilities and upper limits on government insurance schemes. They can try and share risks with the owners of those risks, such as by guarantee fees, by deductibles or fees for government insurance schemes and so on. They can try and transfer risks by purchasing insurance. They can hedge against risk by cross-currency or interest rate swaps and so forth. And they can also regulate through banking regulation or legislation on building and environmental standards. So various ways that governments can take policy actions to mitigate fiscal risks. And many countries, of course, are doing just that. So a little bit now skipping on to some of the tools that are available to quantify and manage fiscal risks. And I'm firstly going to turn to one which has been developed by the IMF over the last few years, called the Fiscal Risk Assessment Toolkit, the FRAT. And this is quite a comprehensive piece of work. It involves several individual units or components, as shown on the wheel diagram here. And the idea generally is to better understand, for countries, to help countries better understand their exposure to fiscal risks, to improve their management of those risks, to increase transparency in reporting of risks. So just going around the chart from in a clockwise direction, let's start with the FRAT itself, which is a fiscal risk assessment tool. It's a tool that can be used by countries themselves to assess their exposure to fiscal risk. It has 14 different components to it. It's a very nice and easy tool to operate, and I would encourage you to have a look at that one. All this information, by the way, is available on the IMF website. So that's one, the Fiscal Risk Assessment Tool. Then there's the PSBS, which is the Public Sector Balance Sheet Assessment, which tries to help countries develop an assessment of their balance sheet, their assets and liabilities. That's a very important thing to do. And many countries, I'm sure, in this region have already done a lot of work on their balance sheets. Then there are a couple of tools which are very important in relation to public corporations or state-owned enterprise. One is called the SOE Health Check tool. I'll come to that in a moment. And the other one is called the SOE Stress Test, which looks at how changes in the macroeconomic environment, changes in GDP or inflation, may impact on the performance of state-owned enterprises. Then there are a couple of tools, the DGAT and the SGAT, which are looking at the guarantees, guarantees issued by the government, and those tools are also available now. There's a fiscal stress test tool, which looks at the impact of changes in macroeconomic assumptions on fiscal risks. And there's also one related to COVID-19, which has been developed. And finally, there's an assessment tool related to public-private partnerships called the PFRAM, which looks at individual investment projects, individual contracts, and does an assessment about the fiscal risks related to those contracts. There's a whole package of tools here which come under this assessment framework called the FRAT. I'd encourage you to look at that and maybe even ask for some assistance from the International Monetary Fund in implementing those tools. So here's an example of one of those tools. This is the State-Owned Enterprise Health Check tool, which looks at various financial ratios of state-owned enterprises. For example, it looks at the profitability indicators, indicators of liquidity, indicators of the solvency of these companies. There are 14 indicators in total. And then in the second box, it categorizes those results into 5 categories, ranging from green, category 1, up to the worst category, which is category 5, where the risks are very high. And in the bottom of the table, you'll see this done hypothetically for a country which has 10 state-owned enterprises, for example, electricity generation. It has an oil producer, it has a rail company, it has a water utility, it has a post office and an airport and so on. So you can measure against the profitability, liquidity and solvency, what category of risk is related to each of those for each of these particular companies. And this just shows, for illustration, how that analysis might work out. And that'll give the government a picture for which of these companies are the most risky and what can be done perhaps to help those companies improve their performance. So this is a very nice tool which can be used to assess the risks related to individual public corporations. Then there's another tool, which is the IMF's Fiscal Transparency Code. You may be familiar with that. The only country, I think, in the region who has done a fiscal transparency evaluation is the Philippines, and that was done in 2015. And one of the pillars of the Fiscal Transparency Code is Pillar 3, which is shown in green here, which is on fiscal risk analysis and management. And that's broken down into 3 components: fiscal analysis and disclosure, risk management, and fiscal coordination. Let me just go quickly through each of those 3 components. So the first one has an assessment which looks at macroeconomic risks, how the government reports on whether fiscal outcomes might differ from baseline forecasts. It looks at specific risks which are relevant to the Treasury, and the government should here provide a regular summary report of the main specific risks to its fiscal forecast, including contingent liabilities. And then there's a third area which looks at long-term fiscal sustainability analysis. So that's the fiscal risk disclosure and analysis. And then the second area is on risk management. And here the assessment is carried out in 7 areas. The first 3 are very relevant to Treasuries. The first one of those is whether the budget has an adequate and transparent allocation for contingencies that may arise during budget execution. The second one is on whether risks relating to major assets and liabilities are fully disclosed and managed by the Ministry of Finance and by the Treasury. The third one is on guarantees, that information on government guarantees are regularly disclosed and authorized by law. So those 3 areas are very relevant to state treasuries. And then there are 4 other areas covered by this assessment. One relates to public-private partnerships. Another relates to the exposure of the government to risks from the financial sector, banks, insurance companies, and so on. And then another one focuses on natural resources, government's interest in exhaustible natural resource assets and their exploitation, and whether a lot of information is provided on the value and disclosure of those assets. And finally, there's one on the environmental risks. So what are the potential fiscal exposure to natural disasters and other major environmental risks? So that's the 7 areas covered by that particular assessment. And then finally, there is information on fiscal coordination, which looks at the areas of the public sector outside central governments. And the first one is subnational governments, which are hugely important to many of the countries in this room, including Indonesia and Philippines, for example. So there should be comprehensive information on the financial condition and performance of subnational governments, which should be collected and published. And then secondly, on public corporations, which are again outside general government, but inside the public sector. So the government should regularly publish comprehensive information on the financial performance of public corporations, including any quasi-fiscal transactions that they carry out. In other words, transactions required by the government but not part of their core commercial operations. And then there's a toolkit also prepared by the World Bank, the Toolkit on Debt and Fiscal Risks. This is largely focusing on debt issues. It's a one-stop shop for public debt managers, providing guidance on the assessment and reporting of debt strategies. So it includes a debt sustainability framework, the World Bank IMF one, debt sustainability analysis, the debt management performance assessment framework, DEMPA, and so on. But it also includes useful information on fiscal risks, including contingent liabilities and other specific risks. So that toolkit is also available and a very useful document as well. So what conclusions would I come to from this little presentation? First of all, I think fiscal risks can have and do have important implications for public finances. Secondly, informed policy making by the government requires data and analysis of fiscal risks and a framework for preparing that information. And this requires inputs not only from state treasuries but from other directorates and departments of finance ministries, notably the budget department and the fiscal and economic policy department, and also other government agencies as well. So this needs to be a comprehensive, fully integrated approach to policy making if it's to work properly. Successful fiscal risk management involves the identification, analysis, and mitigation of risks. It needs to have that information incorporated into the budget, and it needs to have a transparent reporting system, as indicated by the IMF's fiscal transparency evaluation, which I do recommend to you, all of you, as a tool for consideration. You need to have sound institutional arrangements for an effective and integrated approach to risk management, stretching across the Ministry of Finance and across the whole government as well. And I think, finally, state treasuries have a key role to play in managing fiscal risks, particularly contingent liabilities, and also, if they're responsible for debt management issues, that as well, which gives rise to further important areas of fiscal risk. So state treasuries need to be feed into the process of risk management alongside other departments and directorates and units of the Ministry of Finance, including economic and fiscal policy, the budget department, and public-private partnerships as well, and also procurement offices if these are attached to ministries of finance. So a number of questions I'd put out for you to consider. First of all, does your government systematically assess the level of, the size of fiscal risks and the nature of fiscal risks? Do you have the kind of approach which I indicated that Ethiopia is following, and where a categorization and register of fiscal risk is prepared? Do you have anything like that? Do you know what your fiscal risks are, how big they are, and where they arise? Secondly, second question, what are the largest sources of fiscal risk in your country, would you say? Are they contingent liabilities? Are they macroeconomic risks? Are they risks related to the environment? Are they risks related to the financial sector? Are they risks related to local governments? What are the largest sources of fiscal risk in your country? And what has been your experience during the COVID pandemic about the realization of these risks? Third question, what categories of fiscal risk are most relevant for your Treasury departments, would you say, rather than other departments of the Ministry of Finance? Fourth question, Do you disclose information on fiscal risks in the budget or other public documents? For example, a fiscal risk statement which I flagged has been prepared by the Philippines. Do other countries do that? What kind of publications do you make on this topic? And finally, what measures is your government taking to manage and mitigate fiscal risks? Do you have a strategy for managing risks that's coherent and comprehensive, or do you operate on an ad hoc basis in managing these risks? So those are some of the questions I think would be interesting to discuss after this presentation, and thank you very much for your attention.